All right, so welcome everybody. As you all know, I go by Adex, and in this presentation, I'll be going over part one of the beginner's guide to the strat. The disclaimer, so first and foremost, I am not a financial advisor. My content is for educational and entertainment purposes only and should not be taken as investment advice. AdexTrades is not a registered investment, legal, or tax advisor or broker dealer. Nothing in the server constitutes professional investment or financial advice. Should you need such advice, consult a licensed financial or tax advisor. And this is the rest of the disclaimer. All right, so now let's get to the strat. So what is the strat? Part one, the basics. Okay. So the strat is a price action trading strategy that was created by Commander-in-Chief Rob Smith, also known as Robin the Black on Twitter. After more than 20 years of studying charts and price action, he noticed that there are specificities when it comes to the way that price moves. That price can only move in three ways. It can consolidate, move a direction, whether up or down, or it can create an outside bar, and we'll be going over this in in the continuing slides. And it applies across all asset types, meaning that you can use this with stocks, crypto, forex, and any tradable vehicle. It eliminates noise and focuses on what we can only see, which is price action. The strat works by analyzing charts on multiple time frames. So when we say that the strat eliminates market noise and only focuses on price action, that excludes all subjectivity. You guys want to make sure that you guys are writing this down, that the strat is objective and not subjective, right? And it's based on what we know to be true and what we see. The strat simply works because there are three universal truths or scenarios that can occur. And I'll be going over these scenarios in the next slide. All right. So scenario one. So make sure you're writing this down. So scenario one, you have the inside bar. Scenario two, you have the continuation or directional bar. And scenario three, you have the outside bar. So remember how I told you how Rob realized that their price moves in three ways? There's three specificities when it comes to price. Price can consolidate, inside bar. Price can move a direction, whether up or down, continuation, or price can take out both sides of the previous range, which is an outside bar. All right. Now, important with the strat is understanding the candlestick pattern and what the candlestick is telling you. You're going to hear a lot of stratters talking about we don't like to use indicators, or indicators is our last line of defense, right? The first thing that they're looking at is simply the candlestick, because the candlestick tells a story. So here's a candlestick. All right, obviously you guys know the difference between a bullish candlestick and a bearish candlestick. The bullish candlestick is green and the bearish candlestick is red. All right, for each candle you need to know four things. You need to know the open, you need to know the close, you need to know the high, and you need to know the low. And I want you guys to write that down. That is very important. You need to know the open, you need to know the close, you need to know the high, and you need to know the low. For the green candlestick, the close will be above the open, and that's what constituted to make it a green candle. For the red candlestick, the close will be below the open, okay? And that's what constitutes that being a red candle. Okay, very, very, very important. And the reason why is because you will be marking these levels on your chart. You will be marking the open, you will be marking the close, you will be marking the high, and you will be marking the low, okay, on your chart. And we'll be going over that in the next slide. So scenario one. So remember that scenario one is the inside bar, okay? So if the current bar's high or low is equal or does not exceed the previous bar's high or low, it is a 1 inside bar, okay? So I'm gonna say that again. If the current bar's high or low is equal or does not exceed the previous bar's high or low, it is an inside bar. So remember, high, low, okay? So if the current bar, let's imagine that there's a bar right here. If it does not exceed the high or the low of the previous, actually, I can do this. Okay, So if the current bar does not exceed the high or the low of the previous bar, then this is an inside bar, right? So this would be an inside bar. Why? Because this low does not exceed this low, and this high does not exceed this high. So this bar would be an inside bar. Okay. Go to the next candle. Okay. This is a scenario 1. The current candlestick doesn't break either side of the previous candle. All right. So if you look at this green candle right here, you see that the high and the low does not break the previous highs or the low, which is what makes it an inside bar. And this is another example right here. You see that this high and you see that this low, that this high is lower than this high right here, and this low is higher than this right here. So this is what constituted to be an inside bar. And remember, if you have any questions, feel free to just unmute yourselves, or you can ask us in the chat. On to the next slide. So scenario 1, high and the low of the inside bar is completely covered by the preceding bar high and low. It's the same example right here. All right. Now on to scenario 2. Scenario 2 is if a candle extends above or below the high or the low of the previous bar, but not both, it will be a 2-directional candle. So if a candle extends above or below the high or the low of the previous bar, but not both, it will be a 2-directional candle. Okay. So in this example right here, if you were to mark the high and the low of the candle, notice how price breaks one side. Price breaks the high, right? It doesn't break the low. Because price broke the high, this is considered a 2-bar. Okay. 2-bar, or a scenario 2 is when price breaks one side. It can either be the high or the low. Okay. Now, this is a scenario 2. This candle only breaks one side of the previous candle, the high or the low. If it breaks the high, this is a 2-up candle. If it breaks the low, it is a 2-down candle. So notice in this example right here, you have that this current bar broke the high of the previous bar. So this would be considered a 2-up candle because it broke the high and it didn't break the low. If it had broke the low, right, and it went this way and it didn't break the high, it would be considered a 2-down candle. All right. Hopefully this is starting to make sense so far. So far we've talked about the scenario 1. The scenario 1 is when the current bar that you're looking at does not break the high or the low of the previous bar. And scenario 2 is when the current bar that you're looking at breaks one side. It can either be the upside or the downside. If it's the upside, it's a 2-up candle. If it's the downside, it's a 2-down candle. All right. Scenario 2, this one broke the, mark your high, mark your low, price broke up, so this is a 2-up. And then for this candle right here, mark the high, mark the low, price broke one side, this is a 2-down. Okay. You can also see for this candle right here, you see that if you mark the high, the low, and you mark the high, price broke the downside. So that's why this is also a 2-down candle. Okay. Hopefully that's starting to make sense so far. All right. So scenario 3. If a candle extends both the high and the low of the previous bar, it will be a 3, which is an outside bar. This is a scenario 3 where the candle breaks both sides of the previous bar. Okay. And what we say an outside, but we call an outside bar, we say that the outside bar is a broadening formation on a lower time frame. And I'll be talking about that in a different slide. So in this example right here, this is the current bar that we're looking at, right? And so you see, if you look at the previous bar, and have you guys noticed that I've been talking about the previous candle, the previous candle, the previous candle. The previous candle, when it comes to the strat, it's always in relation to the candlestick, the candle before it. When it comes to any of the actionable signals, it's always in relation to the candlestick before it. Okay. So current candle right now, you see that the candlestick before it, you have your high and you have your low, and you see that price broke both sides. Price broke the upside and it also broke the downside. Okay, so what we say about a scenario 3, and this is very important, you want to make sure that you're writing this down as well, is that a scenario 3 cannot occur without becoming a scenario 2 first. So an outside bar cannot occur without well, that's pretty much redundant. But an outside, so what we say is that once a 3, always a 3, right? And so once you create a 3, you cannot, it's always starts from becoming a 2 and then going 3 down. And let me explain to you what we mean, right? Let me erase this. So in order for this 3 bar to be created, remember this is the high and this is the low, all right? In order for price to be able to break both sides, we had, imagine we had opened, oh no, we opened here. So we opened here. We opened here and we were already up. We gapped up, so we were already created a 2-up candle. But then price, so because price opened here, we're already a 2-up candle. Okay, so hopefully that makes sense. We gapped up, so that's a 2-up, right? And then price goes down, all the way down, all the way down, all the way down, and it breaks the opposite side. Because price was able to go up, take out this high, and then come down, take out this low, that is what it creates a 3. All right, I'll be showing that in a different slide. This is another example. This is an example where we gapped up. So we gapped up from here all the way to this open. And then, so price broke this high, right? So it's a 2-up candle right now, 2-up candle, but then it comes all the way down to break that low, and it becomes a 3 candle to the downside. Okay, this is an example. This scenario 3, price opens right here, right? Price goes up. Oh, let me actually erase this. So this is the high and this is the low. Price opens here. It goes up to create a 2-up candle. Then it goes down to create a 3. All right. So that's what we mean by we say once a 3, always a 3. And in order for a 3 to be created, you had to create a 2 first in one direction, and then you had to take out the opposite side. Okay. Scenario 3 is when the candle breaks both sides of the previous range. It is one of the most important elements of the strat that every trader should know. Once a 3 exists, it will save your portfolio, because once a 3, always a 3, and cannot be. It starts as a 2 in one direction, but then it fails and it goes into the opposite direction. What we also say about 3s is that an outside bar is created on a lower time frame. Okay, and I'll be talking. Not the outside bar is created. A broadening formation is created on a lower time frame. Okay, so and then yes, I already talked about how once you start with the 2 and you start with the 2 up, and then you go out to the opposite side to take out the opposite side. All right. Now we're going to be going. All right. So part 2. The 3 key elements. So remember, just to go over review real quick. So you have your scenario 1. Your scenario 1 is your inside bar, where you're not able to take out the high or the low of the previous range or the previous bar. Then you have scenario 2, where it takes out one side of the range. It either takes out the upside or the downside. Okay. And then you have scenario 3, which is where it takes out both sides. Okay. Hopefully that makes sense so far. Any questions? We good? Seems like we're good. All right, now I'm going to be going over the 3 key elements. All right. All right. So the 3 key elements. So the 3 key elements to the strat. The first one is time frame continuity. The second will be broadening formations, and the third is inside bars. So the first is time frame continuity. So time frame continuity refers to achieving the highest probability of trades when one side is particularly present during that trade at that moment. It's our goal to identify who is actively in control in the given market, whether that be buyers or sellers. And this time frame continuity occurs when all time frames are pointing in the same direction and shows if the different participation groups are agreeing with each other or not. Ideally, with the strat, we want to identify and trade stocks that are moving in the same direction in all time frames. So in other words, the best opportunities tends to lie in stocks that are trading in the same direction on the current quarterly, monthly, weekly, and daily candlesticks. So if a stock is trading and aligning to these principles, we consider this stock to be in full time frame continuity. All right. So this is an example, and this is an indicator that we use called time frame continuity by Crinkle-Brine. And this pretty much tells you if the stock is moving in full time frame continuity or not, right? So notice how when you see that the day is green, the week is green, the month is green, the quarter is green, the year is green, what that's referring to is that if you were to go to that chart and pull up that time frame, the daily time frame, you would see that it's green on the daily time frame. If you were to put up the weekly chart, you would see that it's red on the weekly time frame. If you were to put up the monthly chart, you would see that it's green on the monthly time frame, quarterly time frame, yearly time frame, and so forth. Let me actually show you an example real quick. Oh, which stock is in full time frame continuity? Google. Hey, Google. Okay. All right. Google. If you go to the daily for Google, you see that we're green on the day, right? If you go on the weekly for Google, you see that we're green on the week. If you go to the monthly for Google, you see that we're green on the month. If you go to the quarterly for Google, you see that we're green on the quarter. And if you were to go to the yearly for Google, you see that we're green on the year. So what does this tell you? This tells you that institutions, not us, institutions have been buying Google in all time frames, meaning that Google is full time frame continuity to the upside, and you can see it with this indicator telling you, hey y'all, Google is green on the day, green on the week, green on the month, green on the quarter, and green on the year. Meaning that they have been buying Google on all time frames. So that lets you know that institutions are buying Googles and they've been bidding the price up. And what you can see when things are in full time frame continuity to the upside, in more cases than not, that means the stock is going up. If you look at Google from the start of the year, from January 1st, or let's go to January 6th, it's been going up since the start of the year, which is why it is green on the year, green on the quarter, green on the month, green on the week, and green on the day. All right. So this is what refers to as full time frame continuity to the upside. Now let's go to Pfizer. Pfizer actually went green today. A lot of healthcare went green today. Hold on, because they've been selling healthcare. Which healthcare did all the health? Is there any? Yeah, okay, Moderna. No, Moderna did it. I was looking for a Moderna shirt. Anyway, so Moderna. You can see for Moderna, you have full time frame continuity to the downside. Actually, and before I go over this, let me show you this example here. Okay. So this is an example where you have full time frame continuity to the upside. This was about a couple years ago. MU, green on the day, green on the week, green on the month, green on the quarter, right? I showed you that example with Google. This is an example where you have full time frame continuity to the downside, okay? You have Twitter, green on the day, red on the day, red on the week, red on the month, and red on the quarter, all right? So this tells you that institutions are selling this stock on all the time frames, okay? And so with the example of Moderna right here, you see that on the daily, they're selling it. On the weekly, I wanted to get into that Moderna short. On the weekly, they're selling it. On the monthly, they've been selling it. And on the quarterly, they've been selling it. And on the yearly, they've been selling it. So this gives you more of a confluence that if you want to enter short, you have more confluence to enter short because of the fact that you know that institutions are selling this stock. All right. Hopefully this is making sense so far in terms of time frame continuity. We as straters want to trade in time frame continuity, right? Because that achieves the highest probability of being profitable in that trade, because that means that we're understanding that we're trading with the trend. If you have things in full time frame continuity to the upside, you want to more times than not, you want to be buying calls, because it could just be TTOing all the way. It's TTOing up. If you see that something is full time frame continuity to the downside, most cases you want to be buying puts, because institutions are selling this stock and they could just be TTOing it all the way to the downside. All right. Any questions so far? We good? Go to the next one. Let me check the chat. Hey, appreciate you, Cameron. Glad you're here. Make sure you're taking notes. I hope everyone is taking notes. All right. So broadening formations. So broadening formations is how price is discovered. We know that price aggregates because for every buyer, there must be a seller. Okay. Price moves in terms of aggregation, and it moves in a series of higher highs and lower lows. If you look at this example right here, you see that we have an outside bar, and this is a scenario 3. And a scenario 3 is a broadening formation on a lower time frame. Okay, so if you were to mark the high, the low, and the high, and the low, okay, right? It's a series of higher highs and lower lows, and then you connect these lines, right? This is a broadening formation. Okay, so that's a broadening formation. On this, I believe this is the monthly, and then I actually drilled down to the weekly. So this right here, this is that scenario 3. Okay, this is that scenario 3, and this right here is that inside bar. Okay, and that is what we do. This is your broadening formation. This is the same thing as this right here. All right, now obviously because of the charting software, I couldn't get the lines to be exact. You might not get prices touch the exact of the broadening formations, but at least you know the support and resistance, right? So Rob often makes a joke, like in his interviews, and he talks about like price doesn't care about your horizontal lines, right? And the reason why he talks about that is because he says that price doesn't move in a box. Price moves in a broadening formation. So it creates higher highs before going lower, right? Then it creates lower lows before going higher. And this is kind of similar to like that ICT concept, because I know a lot of you guys are familiar with ICT, where it has to take out sell side liquidity or buy side liquidity. And what that is pretty much just hitting that broadening formation and then coming down, or hitting the bottom of the broadening formation, taking sell side liquidity and going back up. That's really all it is. So price doesn't move just in a box from just horizontal line to horizontal line. No, it can break that horizontal line, create a higher high before coming down, breaking that other horizontal line, create a lower low before going back up. This is really how price moves. All right, that's really how price moves. Go back down. All right. Okay. So this is just that example right here, where this is the outside bar, this is that outside bar, okay? And you can see how price moves in a series of broadening formations, right? And the reason why we draw these lines, these broadening formations, because we want to know the range of where price can move. Now that we have this broadening formation right here, I know price can go here, 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 right? I now know the range of where price can go. And then if it wanted to get back to the bottom of the range, right, and now we start to hammer, I could say, hey y'all, price is hammering at the bottom of the broadening formation, now we can get calls and look to take it to the upside. Okay. Okay. So how you draw broadening formations: draw the previous high and low before the outside bar is created. And then you can also think of broadening formation in terms of supply and demand. When a stock reaches a new high, it means that a new group of buyers have been identified above the previous high. Eventually, that buying pressure exhausts and the stock retreats or retraces. This new group of buyers become trapped, and this is what creates selling pressure to the downside. All right. Inevitably, the stock will eventually get pushed towards the previous low. As the stock pushes towards this low, those buyers at the highs will succumb to the selling pressure, drive the stock to the new low. All right. This low will eventually get bought up by buyers at the demand zone, and the stock will resume higher to create highs until it reaches the next new high. And this series repeats itself, and that is what creates the broadening formation.
You didn't even come kiss.
33B, I had to mute you because your mic was on. But if you have any questions, please feel free to ask. All right, and let's go to the next slide. Formation. All right, so how to draw your broadening formations. So you're able to be, so once you're able to identify the highs and lows, you draw back from the current high to the previous high and from the current low to the previous low. All right, you'll know it's a high because price action will reverse and go to create a low. All right, this is important. I need to show you guys how to draw broadening formations because it might be difficult. All right, let me go to Moderna. All right, Moderna, perfect example on the 10-day chart. This is a broadening formation. So a broadening formation is when you take the current high, right, and you take it back to you draw it from the current high and take it back to the previous high. And then you draw it from the current low and take it back to the previous low. So right now, if I were to look at Moderna on the day, okay, if I were to take the high of Moderna right now, the current high of Moderna, you have to take it from the current high to the previous high, but that previous high has to be lower, right? If you look at Moderna and you take it to the previous high, this high right here is higher than the current high. This is not a broadening formation, okay? The broadening formation is created from the high to the previous high, which has to be lower than the current high, and then it gets, so this is how we say. So we say higher high. We say from the lower high to a higher high, and then from a lower low to a lower low to a lower low, or a higher low to a lower low. Let me say that again. So you take it from a lower high to a higher high, and then you take it from a higher low to a lower low. So let me show you where that would be drawn for Moderna on the 10-day chart. The broadening formation will be from here, here. Okay. And actually, let me draw it. Okay. So whatever the current high is, right, you have to make sure that the previous high is lower than the current high. Whatever the current low is, you have to make sure that the previous low is higher than the current low. All right. Some people will draw a broadening formation like this down. This is not a broadening formation. This is a downtrend line. And the reason why this is not a broadening formation in a downtrend line is because price has to be drawn from a high to a higher high, high to a higher high, low to a lower low. Okay, make sure that's how you're supposed to say it. High to a higher high and a low to a lower low. Okay, in this example, we have price being drawn, the trend line being drawn from a high to a lower high. Remember, broadening formations is from a high to a higher high and a low to a lower low. So I'm going to remove this line, and then you can see And how you know it's a high is because price action will reverse and create a low. Okay, and so you can see the path here. If you were to draw a path, you see that price went from here, went to this high, went to this low, went to this high, went to this low, went to this high, and then it's now right here, right? And strat traders, the reason why we like to draw our bonding formation is because we like to take things off of reversals. So we understand that, hey, when you're about to go to the bottom of the bonding formation, as soon as you get a reversal candle that tells you that price could possibly reverse back up, and you take the trade back up. Same thing for the upside. As soon as you get a reversal candle when you're at the top of the bonding formation, you know that the possibility for you to go to the bottom of the bonding formation is high, well, based off of continuity, right? You want to make sure that continuity is with you. So this is why bonding formations are important. Okay, you want to make sure that you're drawing it from a high to a higher high and a low to a lower low. And then so if I were to look at a different chart, Costco, right? The broadening formation, people will say, oh, I have this broadening formation for cost. That is not a broadening formation. Why? Because you are drawing price from a high to a lower high. Remember, you want to be drawing price from a high to a higher high and from a low to a lower low. So this is not the broadening formation, but where is the broadening formation? Right here. High to a higher high, low to a lower low. Okay, this is a broadening formation for cost. And why do we like this? Because we know that Costco can move in within this broadening formation right there, right there, 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 there. And the possibility now, right? Costco, if it wants to, we're not saying it will, but we know that the possibility for range, as long as full time frame continuity remains up, Costco can go to this broadening formation before reversing back down if it wants to, right? We know that this is the range that Costco can move. Okay. Right. Hopefully that makes sense. All right.
Does the time frame where you draw your broadening formation?
What's that? Does the time frame?
Yes, does the time frame matter?
No. Oh, great question. So no, it actually doesn't matter. Broadening formations are seen on every single time frame. And there's another question that people ask, do you draw one broadening formation? You draw all broadening formations. You draw as many broadening formations that's going to help you in your analysis. And the reason why we draw those broadening formations, so for example, this is a plain 10-day chart for Costco. I'll start with the 6-month, right? Let me actually remove these drawings. And what we do as straters, and this is what I recommend, you want to draw your broadening formations on the higher time frame. So I start off with you can start off with the yearly, right? Start off with the yearly, and then you mark, and then you change the color of the broadening formation so you understand that if it's a yearly broadening formation, a monthly broadening formation, a 3-month broadening formation, or a daily broadening formation. The reason why we color code our broadening formations is because just like how we have that saying, the bigger the time frame, the bigger the breakout, that's also the same with whatever time frame the broadening formation is on, the bigger the breakout or the harder the resistance, right? So if you are about to approach a yearly broadening formation, you can assume that if you reject there will be a harder rejection as opposed to you just breaking through a daily broadening formation. Does that make sense so far? Okay. Now you see that I'm on the quarterly, right? This is a quarterly, so I'll mark this. Right. Then, and I have another broadening formation, and then I can actually tighten this broadening formation. That's that yearly one. Then I go to the monthly. Now I see another one. Broadening formation. Broadening formation. Broadening formation. Okay. So far I have the monthly broadening formations. Then I go to the weekly. Broadening formation. Broadening formation. Okay. Now, so you see all these lines, right? And at first you're gonna be like, what the hell? Why you got like, it looks like lasers and stuff like that. But the reason why it's important is because price bounces and reverses off broadening formation. And if you color code them, you will see harder rejections or bigger breakthroughs. So just like with this example right here, you see that price broke through this broadening formation, right, on the weekly, and it retested it, came up, retested it again, then broke through this, then actually reversed off this broadening formation for continuation. Then we broke through this broadening formation, hammered off it. We went to this broadening formation, went to this high, to the yearly broadening formation, and reversed. Okay. Then you can see that we hammered off of this broadening formation, or we close above this broadening formation. Then we hammer it, go up, go back to the yearly BF before reversing, creating a 1-3 pattern to the downside. And then you see that we break through this BF, then we break through this BF, we hammer here first, then break through, then we eventually reverse off of this broadening formation here. And the beauty about broadening formations is that you can see them. If I were to go to my SPY chart, oh, I deleted all my SPY broadening formation. Oh, I did. Let me see.
Hey D,
Yeah.
can you explain what outside bar is an evidence of?
Oh yeah. So an outside bar, great example. So the outside bar is evidence of a broadening formation. So let me show you if I could find one. Let me show you. Okay. Okay. So Costco on the month, right here, right? Costco went 3 up on the month. This is evidence of a broadening formation. So let me mark this. Actually, let me go to this one. Costco on the month. Costco is evidence of a broadening formation. Right here on the monthly, if you were to draw this broadening formation, let me mark this yellow. Right. Okay. And then I were to go drill down on the lower time frame, let me go to the daily. Okay. So that candlestick, let me go this. Okay. So Costco on the month right here, right? You see this 3 bar? Remember how we talk about this is evidence of a broadening formation? Because this high is connected to a higher high, this low is connected to a lower low. This is the same thing if I were to mark it right here. That's not going to do it correctly.
Trading views sometimes, the lines kind of don't line up as well when you go on lower time frame.
Yeah, it sucks. Anyway, so this right here, that is evidence of this taking out both sides of the range. Okay, you see this bottom of the 3 right here, the bottom of the 3 bar and the top of the 3 bar, that correlates to this range right here. Okay, this would be that 3.
Oh, so an outside bar is just evidence of a broadening formation on a lower time frame. Is that what you're saying?
Correct. This is it right there. An outside bar is evidence of a broadening formation on a lower time frame.
Question.
Yes.
What you just said, can you break that down to something that's more easier to understand? Yes, it's evidence of a broadening formation on a lower time frame, but what does that mean? What is the significance of saying that?
So the significance of understanding that it's evidence of a broadening formation in a lower time frame is that you're able to identify the range, right? And when we talk about identifying the range, we talk about identifying the range and price discovery. When you take out the highs and the lows of the previous bar, you are now in what we call price discovery. And so you are now need to figure out where can price reverse, right? So let's say, like, look at cat. We can look at cat, for example.
Adex, can I add one more point?
Yes,
that?
yes.
Thank you. So price discovery is the same as finding new liquidity. The market is finding new potential buyers or sellers on either side of the broad information. Every time you reach a new liquidity, there's potential for price to reverse. And that's what Adex is saying. Is that correct?
Yes, 100% correct. 100% correct. Let me see if I can find the broadening.
So as opposed to a conventional pivot system to find price targets, you can target the broadening for some price targets too, right?
Correct. Oh, you can't do 18 one? Oh, you can't do 18 one? Okay, whatever. You can't do 18 one. All right. So, Bo, to answer your question. So when you see that, oh, this is a great example right here. Okay, cat on the 6 month. Cat on the 6 month. Okay. So cat right here, on this 6 month chart, it went 3 down and then it went 3 up, right? And because so you can see that with this 3 that it created a broadening formation. And so with this 3, let's say pretend that the yellow one is not there. Okay, pretend that the yellow 3 is not there, that we just created this white 3. This is evidence of a broadening formation because this is where that white 3 would have been, right here. Okay, this is where that white 3 would have been. Okay, and so once you create that 3, you draw your lines so you can create your broadening formation, so you can know the possible areas where price can go to, right? Price can bounce here, bounce here, bounce here, bounce here, right? The possible areas where price can go to before reversing back to the upside. Okay, so once this 3 was created, that tells you that a broadening formation exists. And then what happened was, how many months later? About 4 months later, you see how price came back to retest the broadening formation before eventually reversing back up. So because this 3 was created in the 6 months time frame, this tells you where the price discovery can possibly occur for the future. And then when it wants to grab new liquidity, when it wants to reverse back down, or when it wants to hit the broadening formation to the downside, then you can see it reverse back up. Does that make more sense? Please let me know.
That makes more sense.
Okay. Definitely. And we can definitely go over more topics about broadening formations and draw more broadening formations and stuff like that. Let me go back to the PowerPoint. Okay. Okay.
I would just want to add one more thing to that.
Yes.
Steph, a profit taker, has a lot of charts using broad information. So if you want to study and learn from her, she, I think, more often than not posts charts with broad information. Some are very small time frames, some are larger time frame, but it kind of shows you how and what price does around that. I don't know who else it's just coming to my mind that Steph is, but it's a good case study to see that it can apply. She even has some on 15 seconds. Like, I'm not kidding you. She took a SPX 300% in 5 minutes using a 15-second chart when price reversed in the last, 0 DTE session thing. It happens everywhere, on every time frame. For beginners, I do suggest, of course, bigger time frames. For most beginners, I've said this before, like in writing, it's better for you guys to swing long term, like at least a few weeks in, so that you don't deal with the emotion of day-to-day price action, and follow ADEX along. Let's say the Costco play. It's working out really great. By the way, congrats ADEX. That was phenomenal. Like, prices was mooning on it. But anyway, for beginners, it is really good to focus on the big time frame setups. I'm talking about the weekly, the daily. But later you'll see that broad informations are an art and a science that you can actually start to discover your eyes, start seeing them naturally. But if you want to use some of the ideas that Steph has, just to study the charts alone and see if you can start seeing similar things. Sorry about that.
You're all good. And the reason why I'm upset, because for my SPY chart, I used to have a lot of like broad information. It was like a laser, but it got deleted for some reason. So I'm trying to put those BS back, but it does take some time. But as many broad information as you can. Show you.
I remember you used to keep them on your SPY, and even later, if price comes back to them, even if it crosses them and comes back, it actually respects them.
Yep.
Almost like, that was wild. I remember.
Yeah, to like a T. That's why as many broad information that you need, like draw them, because they will help you out. Price will somehow in some way come back to respect those lines. So like with this AMD, now we're in this range. It can come back all the way to this range, come right back down. Who knows, right? Hit this top of this broadening formation and then come right back down. But this is why we love those broadening formations. Let me go back to the PowerPoint. Okay, on to the next slide. All right, so the third key element to the strat is inside bars. All right, so also known as scenario one, and we love inside bars. The reason why stratters love inside bars is because inside bars are actionable signals, and actionable signals we're going to be going over. Once you see an inside bar, you know what to do. The reason why we say you know what to do is because you know what the inside bar represents. Inside bar represents consolidation or equilibrium between buyers and sellers. Once price breaks two up or two down, then you know who wins. So for example here, if you see this inside bar, you mark the high, you mark the low, right? This is your consolidation bar. Buyers or sellers are both trying to see who's going to break out. Then once the following bar opens, and if it breaks two up, then you know buyers won. If it broke two down, then you know sellers won. Okay, and this is just in terms of the basic concepts. There's like more advanced strategies in terms of like if a reversal occurs or things like that. But just in terms of the basics, when we talk about the inside bar breakout, the reason why it's so powerful is because you're going from consolidation to expansion. All right. Neither buyers or sellers have control of the stock, but one will soon. We enter on the break of the inside bar on either side. Okay. This is an example, right? You have your inside bar, you mark the high, you mark the low, and then you want to take the side of whichever side breaks. So two up or two down. This side it broke two up, so you would want to be in calls. Okay. This example is the same thing. Next one. All right, another inside bar. You mark the high, the low, you mark the high, and then whichever side breaks, you want to be in calls or puts. So this side, it broke 2 down, so you would want to be in puts, right? All right. We don't need to go over that. Oh, I can actually, I'll say this. So when it comes to the strat indicator, right? And you have these numbers on underneath the candlestick. This is just pretty much just helps you understand, like, if you're an outside bar, inside bar, or a directional bar. You'll see in my charts that I only have 3s and 1s showing, and the reason why is because everything else is considered a 2, right? So if it's not inside or outside, then it's, it's a directional bar. So that is why you'll see in our charts, go back. Okay, boom. All right, so you see this can, oh, and if you guys haven't figured out, yellow is green and white is red. Here we go. Sorry, don't want to confuse you guys already right now. All right, so you see for SPY, you have outside bar right here, takes out the previous high and the low of the previous day. You have your inside bar, which is inside the high and the low of the previous day. And then you have your 2 down candle, because it only breaks one side of the candlestick compared to the previous candle. And you have your 2 up candle, because it only breaks the upside of this candle. Okay, everything is in relation to the previous bar. Back to the PowerPoint. All right, so the truth about the strat. So we know that price doesn't move, it aggregates. And you'd like to think of price occurring in pairs. For every buyer, there must be a seller. So that means that when there's more buying, that means more selling is also occurring, which creates volatility in price movement. Price action everywhere is price action anywhere. And the strat only follows price action, so it can be used in any asset. So when we talk about, you see an inside bar, you see an inside bar on the monthly, or you see an inside bar on the weekly, that means the same thing. The inside bar, all it means is that there's been consolidation on that time frame that you're looking at. So if you're looking at an inside bar on the monthly time frame, that tells you that they have been consolidating, price has been consolidating for the month in comparison to last month's price action or last month's movement. If you see an inside bar on the weekly, that is telling you that price has been consolidating in comparison to last week's movement or last week's price action. Because you're going to realize, and you're going to understand that once you're looking at those candlesticks and you see a 322 rev on the month, that is the same thing as a 322 rev on the daily. But the amount of time that it takes to get to the target, that's just different. All right, but we'll be talking about that in different slides. Price discovery works in a series of broadening formations, and we know that simply because outside bars exist. An outside bar cannot occur without being a 2 first. So you can think to go long on a stock, but then watch price fail and go against you. This is what creates a fail 2 up or down and can lead to a 3 being created. So personally, this is the reason why I no longer get scared or no longer get pissed off when movements fail, because you understand that 3s exist, right? You understand that, hey, CVS today can break 2 up on the day and then proceed to come down, right? That the reason why that occurs is because outside bars exist. Price can go 2 up and then come down and take out the opposite side. That's just what happens because 3s exist. The likelihood for 3s occurring, like whatever asset that you're trading is low compared to a 2-directional candle. But because threes exist, you know that, hey, price can break 2 up and then come down, or price can break 2 down and then come up to take out the opposite side. Also, we like to say that the strat is right, but what we mean by the strat is right is that the strat is objective in its nature. The strat doesn't rely on any subjectivity. It only relies on the price movement. So notice how when we talk about the candlesticks, we're saying that when we say price breaks 2 up on the day, we're meaning that the price of that equity or the price of that stock, right? If yesterday's high for Apple was at 150.10, if today Apple goes 150.11, price broke 2 up on the day. And what we mean by price breaking 2 up on the day is that price broke yesterday's high. Right? When price breaks yesterday's high, as long as Apple goes to 150.11, there is no subjectivity about, oh, I think it went up, or I think it's no. What did price do? It went to 150.11. It therefore went 2 up on the day. There's no ifs, ands, or buts about that. That's why there's no subjective analysis when it comes to this strat, because it is what it is. Did price break up in the day? How do you know? Price has to break yesterday's high. So as long as price literally goes to 150.11, it did that. It's not maybe I think it break. No, it did that. Even if price comes down, at least we did break yesterday's high by going to 150.11. All right. That's why we say that the strat is objective in its nature. Okay. So now let's move on to the strat guide. All right. Any questions so far? Who are you talking about? Because yes, this will be recorded. All right. So trading the strat. Now this is on to part 3. All right. So the strat guide. So for those of you that have not seen the strat guide already, make sure that you go to the bottom of the channels list and look at go to our education section of the Discord, where we have the lessons. The tools and education section of the Discord, and go to the strat channel. You'll find this strat guide. I want you guys, now the strat guide is interesting because some people say like, oh, you don't need it, or no, you do need it. The reason why I do recommend the strat guide is because I want you guys to not necessarily get the actionable signals engraved in your brain, because the more you trade the strat, you will naturally get the strat signals engraved in your brain. But you want to start finding the one that you like. Start finding the actionable signal that you like. All right. So these are what the actionable signals consist of. Right? You have your 212 bearish reversal, 212 bullish reversal. I'm going to look at the inside bars right now. You have your 312 bearish reversal, you have your 312 bullish reversal. All right. Now these ones, the 212s or the 312s, the reason why we like those actionable signals, or the reason why they're popular, is because you're going from consolidation, that inside bar, to expansion, and whether that's going to be a 2-up candle or a 2-down candle. All right. I'll be going over that in more detail. So actionable signals. The actionable signals, for those of you who are asking like, oh, what does he mean by actionable signal? That is the reason why we enter the play. So if we say, hey, Apple has an actionable signal on the 15-minute, it's saying that it has a signal for you to enter the play, right? Whether that's an inside bar that's about to break 2 up, or a hammer candle and a new candle is about to form and is about to go 2 up, a shooter candle and the new candle is about to form and is about to go 2 down, or a Momo hammer and a Momo shooter. Actionable signals are the reason you enter a play. Another reason why the strat is universal is because there's only a few actionable signals, but there are a lot of more combos that you'll soon be able to recognize. All right. And these are the actionable signals that we have. I guess there's more, but these are like the main ones. Okay. So the inside bar. Remember, for the inside bar, this is the rule number 1. You never want to trade the inside bar. You only trade the break of the inside bar. Okay. So when you see that inside bar on a time frame, if you're looking at the daily chart and you see that, hey, we're inside, that we're currently 1 on the day, you're in. Okay. once you get better at the strat, you will be able to trade inside bars, but just on the basic level, you're technically not supposed to trade that inside bar. You're supposed to trade the breakout of the inside bar. So if you see that we're currently at 1 on the day, you wait for the next day, once it breaks 2 up or 2 down, to play that inside bar. Okay, that was just like, let me show you the example of Costco today. Costco. Okay, Costco is a beautiful example of a 2-1-2, a classic 2-1-2 up, a classic 2-1-2 up for Costco. And the reason why is because what happened yesterday, right? Yesterday, we've been in the swing for a while, and Costco, it went up, and we were like, oh yeah, Costco, but it was inside. So that's why I didn't really care for Costco. But then because of the fact that it created an inside day, I know that, okay, now you're setting up for either a 2 up or a 2 down day. Costco has full time frame continuity to the upside, so more times than not, it will probably be creating a 2 up day. And that's when Costco went stupid today, because you went from a place of consolidation to a place of expansion. All right. So for Costco, yesterday, after the close of the day, you mark your high of the candle, entry, right, and your low of the candle. And if Costco goes 2 up, you enter calls. Costco goes 2 down, you enter puts. All right. That is the inside bar breakout. You don't trade the inside bar per se, you trade the breakout of the inside bar. So that means if you're looking at the daily chart, you wait for the following day. If you're looking at the weekly chart, you wait for the following week, right, to play that weekly inside bar breakout. All right. Back to the PowerPoint. Price targets. Okay, so price targets are the wicks of the preceding bars. This is where buyers and sellers place their stop losses and the point of the decision making. All right, so if you're looking for those price targets for Costco, this is the reason. Oh yeah, this is like the reason why the strat is so like powerful, because our targets are defined for us as well. All right, so when you see the inside bar breakout for Costco and you're asking like, okay, but where's my target? You just look. Remember, it's a three candle combo. Okay, when we talk about the actionable signal, it's a 3 candle combo. There's some 2 candle combos, but majority of them are 3 candle combos. So we're looking for that. Once that 2 was created, or that 1 was created, here. Okay, once that 1 is created, you're looking for today whether or not we're going to go 2 up or 2 down. Where are your targets? Your targets are the top and the bottom of the 2. Okay. Remember, 3 candle combo. The new candle will open today. If you break 2 up, where's your target? This is your target for the upside. And this is your target for the downside. Okay? Does that make sense so far? This is very important. When it comes to playing the actionable signal, when it comes to 3 candle combos, the reason why we are so confident when it comes to our targets is because the strat tells us where our targets are. We don't come up with arbitrary numbers and saying, hey, we have a target here at 509.10. No, the reason why we say 509.10 is because the strat says the target is at 509.10. And that's what adds to our confidence. Not just understanding that we have an entry point to where we could take the trigger, but also understanding that we have an exit as well. And this is on the basic level, right? Just with the first price target. Once you get more comfortable with the strat, you have multiple price targets and things like that. You have a price target in between 505 and 509 that you could be taking profits at. But just based on the basic level of the strat, when it comes to the 3 candle combos, the price target is based off the preceding candle. All right. And what you can see, if I were to go on the 15-minute, you can see price react to those price targets. If I were to play it, I want to pause it here for a second. You notice how Costco on the 15-minute time frame, it broke the entry for you to go long, right? So it crossed your entry point. And look what happened. It went up, you're in profits, then it started to retrace. But look at where it hammered. This is why I talk about levels and marking your entries for the daily, the weekly, the monthly, and so forth and so forth. Because price will somehow, in some way, find a way, will retest these levels. Notice how Costco retested that daily call trigger to enter twice. It came down once, retest. Buyers are definitely here. Came down again, retest. Buyers are definitely here. And then now, TTO back to the upside. So when you hear, if you're entering like a day trade, right, and price goes up, you're in profits, and all of a sudden starts coming down, and then like people say like, hey, are you still in the play? Are you still in the play? And I'm like, yeah, we're still above the daily call trigger. The reason why is because that can be used as a possible support, for a possible point of support where price can reverse back to the upside. You will see it happen a lot. And that's why it is very important to walk that daily call entry, weekly call entry, weekly 50%, monthly call entry, because you will see buyers be at that level if price wants to continue going up. Boom, there it is. Let me go back. See? Look how, oh, no. You're supposed to go back. Okay. I don't know why it's not. But did you guys see how it became a shooter before it became a green engulfing candle? So that shooter, that was a reaction to that price target right here. So when Costco gets to 509.10, you are supposed to be taking profits. You should be taking profits because that is the target based off the 212 up on the day, right? Obviously, it can continue going up because you do have full time frame continuity going up. And Costco is an example where the higher time frames are saying that Costco is going to continue going up. But when we talk about marking your price targets, this is what we talk about. If Costco broke 2 down on the day, you want to be making sure you take profits at that trigger right here at 497.86, and then you can continue going to this price target right here, right? These wicks, all these wicks are price targets. Every single wick. That wick is a price target. This wick is a price target. This wick is a price target. This, you can mark as many wicks as possible. But when it comes to the strat, the wicks are the price target. I want everyone to write it down. So everyone, and this is very important. When it comes to taking trades, I want when you ask a question, I want everyone to be able to take a trade and know their defined price target before taking the trade. Why? Because the strat tells you where those price targets are. The price Costco tells you. Oh, hold on. Sorry, we got a hot mic. Got you. So Costco is telling you where those price targets are. 512.82, 514.85, 516.84, 519.14, 521.79. Every single wick can be used as a price target. Why? You will see market participants at that level, and they will either take profits, they will either break through at that level, enforce, or you could see some consolidation at that level. But that is those areas where you can be taking profits. All right. Let me go on to the PowerPoint.
Are you recording right now or no?
Yes, I am recording.
Okay, because you said you paused it, so
okay, now you have your actionable signal, Momo hammer, and a Momo shooter. Okay, so the hammer. All right. So these signals identify when price has shot up, but the price is trying to be bragged. So the hammer signifies when price shoots up, but was originally dragged down by sellers. All right. So price is being brought down until buyers stepped in and then shot price back up. The hammer becomes live on the break of the next bar. So, and important, think of the hammer as building something up. So what happened with this candlestick right here? All right. What happened was we opened right here at this level, and price originally went down, right? You can tell that price went down because the formation of the wick. Price went down, but then all of a sudden, price started to go up, all right? And then we closed right here, okay? So what does this mean? Remember how I talk about how each candlestick tells a story? So this hammer candle indicates that sellers were originally in the play, they brought price down, but then buyers stepped in and they brought price up and they closed it relatively near the highs. So when I ask people, I say, what does this candle mean, right? I'll say, tell me what happened in this candle. Like, what happened in this candle? Literally, like, what happened? You should be able to say, all right, originally to start out the day, sellers were here in the play, but then to close out the day, buyers stepped in and we closed relatively near the highs. Then I'll ask you, all right, who was there last? You should be able to say that buyers were there last, because what does the candle tell you? The candle tells you that they were able to bring it up towards the end of the day. And then the following day, you see that price breaks 2 up on the day. As soon as price breaks 2 up on the day, this hammer is in force, okay? Or we say that the hammer is live, because that gives you the confirmation that buyers indeed, if it went down, then they indeed brought price all the way up, and they kept bringing price all the way up, okay? That is what we mean by the hammer is live. Buyers stepped in. Originally, sellers were in the play. But then buyers stepped in this candle. And then the next candle, you get the confirmation that buyers definitely stepped in. And now it's in force. So hammers, we love playing hammers, because especially for calls the next day or for the next candle, because once we see that hammer and the following candle, it goes 2 up, then we know that buyers are in force. All right, shooter. Shooter is pretty much the opposite. So a shooter occurs when sellers start to take profits. The shooters become live on the break of the next bar. All right. Just because you see a shooter doesn't mean to get out right away. It is confirmed when the next bar breaks the entry to the downside. So what happened in this play right here? So price went up, or consolidate, price went down, then price went up, right? And then all of a sudden, sellers started to step in. Profit taking. We reached a new high, broadening formation. Sorry, that's not broadening formation. Right? We reached a new high. And then now you have profit taking. Now sellers start to step in. Sellers step in, they bring price all the way down, right? But then the next candle, that is when it actually goes in force. And that is when you actually can go in for puts, because you know that this is confirmation of this profit taking that occurred for this candle right here. All right. Let me show examples. Hammer, Apple. Okay, so Apple on the 10-day. Oh, actually, this is a good one. So Apple on the 10-day, you see what happened. Price went down all the way to 129.30.17, and then buyers stepped in. They brought price all the way back up relatively near the high. The following week, price went down again, but then buyers stepped in and said, nope, we're not going to allow you to break 130, right? And then you could see that what happened afterwards. Sorry. Okay. Sorry. Apple on the 10-day. Okay. So this is Apple 10-day. So Apple on the 10-day, you see right here that you have a hammer candle. Okay. You have a hammer candle where Apple couldn't break below 129. Then you, on the following 10-day candlestick, you see that Apple couldn't break below 130, right? This was a hammer candle. Price went down and went up. Price went down and went up. And then the following candles, you see the follow through, right? If you enter here, this would be your entry. This would be your entry to go long. Okay, off of these hammers right here, because buyers stepped in. What we like to say, like, what is the candle telling you? The candle is telling me that buyers stepped in, that price tried to break 129, but then buyers stepped in on this 10-day chart. The following week or the following 10 days, the buyers or price went all the way down to 130, but then buyers stepped in. And because buyers stepped in, then you get that follow through the next following candle, and then boom, price goes to 175. This is also
ADEX, why do you use the 10-day sequencing?
You said what?
Why do you use a 10-day sequencing?
You really want to know why? Because the 10-day chart, 10-day chart has like, it's very clean when it comes to actionable signals. Let me try to show you with Apple. So, and in terms of trends, right? So look at this. You have your outside 3, and then it goes. You have 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6. 6 down candles before getting your inside 1, 2, 2 rev to the upside. But this is a clear trend, right? Then you have your 1, 2, 2 rev actionable signal right here on the 10-day. Then you have another trend up, right? Then you have your actionable signal 3, then tells you to get out of your long, trend down. Then you have another actionable signal to the upside with the 3 up, get out of your short, trend up, right? Then you have another actionable signal on this 10-day. You have your 3, okay, might want to get out of your long because you created a 3, but then you have a 3-1, and you know once you get that 3-1-2, then look how long that 3-1-2 takes you to go up for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and then you finally get your shooter candle. You can get out of your long right here, and so you see how clear like the trends are when it comes to the 10-day. And that's pretty much why I use it. You have your 1-3 ref strat, then you know to take it short. Costco is also a good example where look at Costco on the 10-day, remove drawings. These patterns are literally defined. Costco inside candle to down, then you have your hammer candle, take it long, then you have a shooter candle, take it short. Inside candle, break 2 up, go long. Shooter candle, 2 down, go short. And you see how long you can go short for? It's not information like these are for swings, right? So once you get that actionable signal on the 10-day chart, you're most likely going to get a move that lasts for about 10, 20, 30, 40 days. And that's why I personally like that 10-day chart. And that's why that's why I'm in Costco right now. Because look at what Costco did on the 10-day. Costco said 3 up hammer. We can go for 1 10-day, another 10-day, another 10-day, another 10-day. Why not? Because they did it last time. These trends are defined, and they will tell you when they're going to reverse. It will let you know when it's going to reverse. That's why like I'm still in Apple, because Apple still said, well, we're 1, 3, 2 up on the 10-day. Because if this is really a true reversal, Apple can go another 10-day, another 10-day, another 10-day.
Thank you. That also explain why you buy time. Now I understand.
Yes, you got it. That's why I got it. Because yes, someone had a question.
Oh, sorry. I finished your train of thought.
Oh, okay. But yes, that is why I really like those 10-day charts, because these trends are like more defined. That would make sense. And the 5-day, if you pair it up with the 5-day, it's see, like here on the 5-day, the 5-day gave you the ref strat signal before the 10-day gave it to you. So that's why I took Apple on the 5-day ref strat. The trend down right here, define reversal pattern up. Then it will give you an actionable signal at the top. You take it back down, and you can hold it for a little bit longer. Hopefully that makes sense. Afi, did you have a question?
Yes. I was gonna ask. You mentioned something about entries. Following a one candle.
Yes.
That's a consolidation. And my question, which has usually been my trap, is with my entries, right? Because of the possibility of a three happening, where we say, okay, following a one, once it breaks one to the upside, I'm gonna enter in. But what I find is like once I get in, it could possibly reverse down and go back down to form a three, sort of. So my question is, are there other indicators that you use in conjunction with, like, to clearly define your entries? Like, are there other things you're watching to see beyond it just going past the previous day's high? Maybe volume or something else like that clearly defines, like, hey, right now I can take this entry rather than just it's beyond the previous day's high.
Great question. Great question. So yes, and it's not actually based off an indicator. The other things that I'm using is multi-time frame analysis and sector rotation. So for example, if I like Costco, I guess, or XLC, good example. Okay, so I guess cost, let me see. XLC, and then we go to.
What are you looking at an example for?
I'm gonna be looking at Verizon, VZ, Verizon. So XLC and VZ. So for Verizon, right? Actually, yeah. Let me do this. So Verizon, do VZ. Okay. This is on the week. This is on the day. Okay. So, and this is on the month. This is on the quarter. Beautiful. All right. So for Verizon, right? The reason why I took the trade on Monday and I said like just watch Verizon go crazy this week is because Verizon had an actionable signal on multiple time frames. I like looking at things in full time frame continuity, sector rotation, meaning that the sector is also green. So if you look at Verizon's in XLC. So if you look at XLC, you can see that XLC drawings. XLC is green on the week, green on the month, green on the quarter, green on the week, green on the day. All right, so that's my first check mark, right? And when it comes to taking trades, you're gonna be, when it comes to your trading plan, you're gonna be developing confluences, or what we say as check marks, reasons to why you should be taking the trade. So my check mark goes as follows: the sector has to be green, or the sector has to be in full time frame continuity, ideally for me to take the trade. So first and foremost, you see that XLC is green on all time frames, right? So that's the first confluence. Then I go to VZ, and I see that VZ had an actionable signal. Well, the first thing that I noticed for VZ was that it already triggered 2-2 reversal on the quarter, all right? So remember, each candlestick tells a story. They have already triggered 2-2 reversal on the quarter. What does that mean? Buyers are here when it comes to the quarterly time frame. All right, so not only are buyers here when it comes to the quarterly time frame, we also know that we are coming off of a hammer quarter. Okay, so we're coming off of a hammer quarter. What does that mean? That means last quarter they've been buying up the price. Price went down and then it eventually closed above the open, and that means they bought up Verizon for the whole quarter, right? This candlestick is telling you that on the quarterly time frame for the last 3 months, the previous 3 months, they bought it up. Sellers were initially there from October to maybe the middle of November, and then from November onward, they started buying it. Then you get your actionable signal on the quarter, meaning that this is a continuation entry. This is a continuation from the quarterly time frame. So what does that mean? For the last 4 to 5 months or so, they have been buying Verizon. Okay, so we broke the quarter. So I see that they're buying it on the quarterly time frame. Then on the monthly time frame, I have a reversal pattern. Remember how I told you that these reversal patterns, they're pretty much clear? If you see a 1-3 ref strat, look at this. 1-3 ref strat, and then it goes, then you see that this trend is down. Then I have a 1-3 ref strat right here on the month for a possibility trend change to the upside. Okay, so I have an X. So the first thing, remember, XLC, and you literally have to write this down. XLC green on all time frames. That's one. The second confluence, they're buying this on the quarterly time frame off of a hammer. So I know that buyers are here based off the quarterly time frame. Then I drill to the monthly time frame and I see that buyers are here on the monthly time frame, not only because of this hammer on the month, the previous month, but it's also a 1-3 rev strat pattern. All right, 1-3 rev strat pattern is one of the actionable signals on the strat cheat sheet that we talk about, that this could be lead to a possible reversal. So you mark that entry for the quarter. This was the quarterly entry. And then I mark my monthly entry. Okay, monthly entry right here. Then I go to the week, right? I go to the week. I see that what did we also do last week? And I'm telling you guys are going to start to notice, wow, these levels are crazy. Because what happened last week? What does the candlestick tell you? The candlestick tells me that Verizon opened up at $39.99. Then sellers were originally in the play, right? Where they brought it all the way down to a low of $38.41. Then buyers stepped in and they were basically able to bring price all the way up and to close it at $40.64. What's the significance of these buyers buying up this Verizon? Where they bought it up was above the monthly call entry and the quarterly call entry, because they're saying that, hey, we want to keep price above the quarterly entry and the monthly entry. So because let me go back to the weekly, right? That they hammered it off the quarterly and monthly entry. We know that we are two up in force on the monthly time frame and the quarterly time frame. Now, Verizon on the weekly chart, remember it had a hammer on the week. So we also marked the weekly call trigger, right? Why am I marking the weekly call trigger? Because Verizon is telling me that last week they were able to hammer price off the quarterly and monthly call entry, and we have full time frame continuity to the upside. So remember, you guys, so far we have an actionable signal on the quarterly that said, hey, 2-2 reversal on the quarterly. We had an actionable signal on the monthly, 1-3-2 rev strat on the monthly, and then we have an actionable signal on the weekly, which is a 2-2 rev on the weekly on top of all of these time frames, or these time frame triggers. Okay, then on the daily, this was what happened on Friday. We had a 1-3 rev strat on Friday, so we had another actionable signal. Okay, daily call trigger. Let me mark this real quick. This is what Friday said. After the close on Friday, this is what Verizon looked like. All right. It had a 1-3 rev strat on the day. It was a fail 2 down on the week. It already triggered a 1-3-2 up on the month, and it held that level because the weekly said we're holding this level. And so now you have actionable signals on the not only the higher time frames, but on the shorter time frames. If you were to look at Verizon on the daily, and if I were to ask you, hey, what is Verizon telling you based off this chart? What did they do? Verizon is telling me that Verizon opened at $40.22. It went down to a low of $39.77, but then they bought it up immediately off the quarterly entry, and then we were able to create an outside day. We created an outside day where we were able to close relatively near the highs, and we created a hammer candle. What does the hammer candle mean? The hammer candle means that sellers were initially in the play and then they bought it up. And they bought it up close near to the highs. We're full time frame continuity to the upside. So remember, right now, I just gave you about 5 confluences that tell you, hey, take Verizon long. You have XLC being green, full time frame continuity to the upside. You have Verizon that already triggered the quarterly 2 up. You have Verizon that already triggered the monthly 2 up off of an actionable signal. And you also have Verizon with the ability to trigger the week 2 up, right? And the ability to trigger the week 2 up, how would you do it, or how could it get there? Based off a 1-3 rev strat candle that is showing you on the day. And you know that 1-3 rev strat candle is actionable if it goes 1-3-2 up. Why can you take the trade, or why do I have confluence that it's probably going to be going 1-3-2 up? Because they're telling me that they've been buying Verizon on all the time frames. They've been buying on the daily, the weekly, the monthly, the quarterly, and the yearly. I like to say that assume every retracement is a TTO back up, a full time frame continuity is up. Why? Because a full time frame continuity is up. This is what that means. This is what FTFC means. Okay? Because on the daily candle, imagine this is a daily candle. Imagine this is a weekly candle. A weekly candle will show straight up. A monthly candle will go straight up. A yearly candle will go straight up. So hopefully that makes sense. And then if you get the following candle, it triggers 2 up on the day, right? So because it gapped up, because Verizon gapped up, right? That is my signal. That is my, and that's actually a great, some people ask me like, oh, we had a gap up, but why were you still so confident to take the play? Because it is going for my, or not is going for, but it is following with my analysis, right? My analysis is that I want Verizon to trigger 132 up on the day to trigger that 22 rev on the week to eventually go up, right? And so as long, and because we had the gap up, that is my 132 up on the day. That is my 132 up on the day. And so, and I'm telling you guys this right now, you guys are going to be able to see, you're going to see these plays where like, oh, you have actionable signals on multiple time frames. Oh, the chart looks so good. Because it looks so good, it's going to gap up the next day. That's usually what happens because they won't give you time to enter because they're like, oh yeah, we know that the chart looks good too. So we're not going to give you time to enter. We're going to gap it up. You should have got in on Friday close. That's usually how they do it. Well, full time frame continuity should be your best friend because full time frame continuity until the trend is proven otherwise. And then that 132 up, we got another 2 up today. So these actionable signals, you guys, like remember how I tell you those actionable signals, those hammered threes for the last, I'm calling like the month of January. I'm gonna be honest with you, has been nothing but me just playing hammered 3 setups. Because or hammer 3 setups or like hammer 2s with where the high is nearly like close to the high of the day because of the fact that it's telling you that hey, buyers are here. Like that hammer 3 is telling you buyers are there, that more times than not you will get a continuation, and all we need is more times than not to be in our favor, right? Match it up with those actionable signals. A 322, if you go to GS, I believe GS is a 322 on a higher time frame. Is it? Oh no, what is it? Costco? Oh yeah, Costco. Costco 322 on a higher time frame. Price action anywhere is price action everywhere. 3, 2 up, 2 up. All right. Hopefully that makes sense, Ifi.
Yes, yes, it does.
Perfect. Perfect.
Question.
Yes.
Can you go back to Verizon and one of your triggers you didn't, I think it was maybe on the month, just trying to figure out how you were drawing your triggers. And you didn't use the 1. You don't draw a trigger off of the 1?
Off
the one candle?
No. So the reason why is because the trigger is based off the previous candlestick. So this is a 1-3 ref strap pattern. If let me go to
Adex,
yes.
do you have a screener that scans for hammer candles on Teams?
A screener?
Yes, I'm like I don't know if you're going through your watch list and just looking through each of these stocks individually, or you have like a scanner that just scans several stocks and kind of selects um those that have the actionable signals that you.
So
we,
oh yeah, go.
I was gonna say, we have an entire channel with all the scanners. And if you go to the strat chat, there's also a bunch of scanners that are pinned. For the most part, you need thinkorswim. So I would I would definitely make an account with Thinkorswim, but we have an entire channel dedicated to scanners. And then if you go to the Strat chat and go to the pinned messages, there's also some pretty nice scanners on there as well.
All right, thank you.
So going back to your question, the about drawing my entry on the monthly. So remember, everything is in relation to the previous candle. So for the month of January, right, we have a new candle. So we have to see if price is going to break the previous month of December, the high or the low. So that is why you mark the monthly entry on the month of December. You would mark the high and you'd also mark the monthly low. So does this make sense? The monthly call entry, because it's in relation. So now that we're going to be getting a new candle for February, this is a perfect example. So now that we're going to be getting a new candle for February, you would have to mark the low of the high and low January. So now this is going to be the new monthly entry, and this is going to be the new monthly entry for the downside. Okay, in comparison to that one, right? For the month of January. So we have to actually, I'm gonna have to update all my charts tonight to mark the new monthly candle open and close, or high and low, because it's going to be this month's range going into the month of February. So Verizon tomorrow, y'all, Verizon will no longer be 2 up on the month. Verizon will open inside month tomorrow. Just letting you guys know. Because why? Yeah.
Go ahead. You were about to explain. I'm sorry.
Yeah, because we're going to be getting a new monthly candle tomorrow. And if Verizon opens here, we are inside the range of January. Because January, the high of January was 42.58, which is what we hit today, I believe. Where did we hit that? Friday the 6th, all right? Friday the 6th. That was the high of January. So if Verizon opens 2 up or 2 down tomorrow, it doesn't matter. It will still be inside month because of the fact now we are inside the range of January's month.
Got it.
Yes. And so you're always wanting to update the information. Once you get new candles, you want to update those candles as well, because they all are going to tell a different story, right? I think that makes sense. So hopefully this Verizon example makes sense why I took it. Full time frame continuity to one side, actionable signals on the higher time frames telling me that buyers are already there, and we had an actionable signal to tell us that they're already there. And then on the lower time frames, we also had an actionable signal where if we triggered one actionable signal, it was going to trigger the next one. But that was a 1-3-2 up on the day, triggering the 2-2 rev on the week. All right. And that is why we like to look at things in multiple time frames, because we want to see those actionable signals trigger each other, because those lead to those bigger explosive moves. All right. Going back to the Okay, so we already talked about this. Your entry is the break of the candlestick. So if you're going, so once you see that hammer created, the next candle, if it goes 2 up, then you know that's your entry as soon as it breaks the entry. The 2 up on the day. Then your exit are the wicks of the preceding candlesticks, which we already went over. For entries and exits, we use tight stops. If that actionable signal fails, you want to be out immediately. This is how we protect our accounts. You always want to start with a starter, then you can add to your position upon confirmation. This is mostly with swings, but that's going to be saved for another slide. All right. The strat language. One of the beauties about the strat is that we are able to talk to each other in a language. So like some of you guys can be at work, but if you hear us saying like, hey, we're about to go 2 up on the day, you understand that, hey, 2 up on the day means that we're breaking previous day's high. So if SPY's high today, or like Abby called out ES saying 4078 today, right? Let's say if that's what was the high. Today's high was 4078. Tomorrow, if you hear me say, hey, you guys, ES is about to go 2 up on the day, you know that means that ES is about to break 4078 to the upside. So if you go to 4078.25, we broke 2 up on the day, because yesterday's high was 4078, right? What does the 1, 2, 3 stand for? We already talked about that. What does up, down, or stand for? 2 up or 2 down. We already talked about that. This are more actionable strat language. AS, actionable signals. A BF is a broadening formation. PMG, pivot machine gun. FTFC, full time frame continuity. TTO, triangle they out. Randy Jackson, which is a 2 down, 2 up, 2 down reversal, or 2 up, 2 down, 2 up reversal. We'll talk about that again. These are more strat combos, and remember the strat cheat sheet that it is in the lessons tab. Okay. So you want to make sure that you are understanding, or you want to get familiar with the strat combos, because you're going to want to trade the ones that you like best. Remember, Abby Side knows this. If anyone wants to, like, I'm having one of my best, actually January was one of my best months. And the reason why I can confidently say, if someone asks, oh, why was January good, is because I played hammered threes all month. Hammered threes all month. Like, let me show you. Hammered threes all month. Costco. On the 10-day chart.
ADEX, is it gonna be recorded?
Yes, sir. It's recorded.
Where are you gonna post it?
I'm gonna post it in lessons.
Okay, cool. Thank you.
Yeah. So Costco. Reason why I took Costco is because we had a hammered 3 on the 10-day, and I believe we have a hammered 3 on the 5-day. Right. Nvidia had a 1-3 ref strat. Remember, I'm telling you, these 1-3 ref strats are like cheat codes. Nvidia had a 1-3, and Novi, this is to answer your question again. 1-3 ref strat on a 5-day chart? Oh, say less. Boom, 2 up, 2 up, 2 up. That's why Nvidia really said we can go to $200, and that's why I'm so shocked, because the strat said we can do it. So 1-3 ref strat, Nvidia. That's why I took Nvidia back when I was in Paris, or you guys remember? 1-3 ref strat on a 5-day chart. Apple, 1-3 ref strat on the 5-day chart. Right? And you guys see, like, I want y'all to notice something. Like, they've been going up for 5 days, 10 days, 15 days, right? So when I say like Nvidia, Costco, Apple, like they pretty much made my month this month, it was because I took it off 3 hammered threes and I just swung it for like 10 to 15 days, right? Because the chart said it was going to continue going up. What was another one?
The strat better come through, because I'm swinging the video.
Hello. You see what I'm saying? Remember when I took Cat last week? The reason why I took Cat was because it was a 1-3 ref strat on the 5-day chart. When I took X, the reason why I took X this week was because it was a 1-3 ref strat on the 3-week chart. I'm telling you, the January, for me, the month of hammered threes, where I was looking for a hammered 3 on any time frame, and if I saw it, that literally told me how long I had to swing the play for. If there was a hammered 3 on the 5-day, I was like, all right, I got to swing this for a month. If there was a hammered 3 on the 10-day, all right, I got to buy 2 months out. And they just played out, because those hammered threes really, really work. If you get that 3-2 up continuation, it's a done deal. It is a done deal. So
you have a scanner for 1-3s?
I don't. I don't have a scanner. What I've just been doing, like, I've just been looking, every day, just going through the time frames and going through the chart setups to just find it. And then once I find it, I'm like, and then I just like you go crazy. But that's just what I've been doing. But those hammered 3 setups, like, those are the ones that they really go crazy, especially with the trendline break. What was it? ES today. When Abisai called out ES, he was looking at the hourly. He was looking at, you guys are going to see this to a T. Look at what happened. He was looking at the hourly, right? And he had a trend line break on the hourly. Look at this trend line break. You had a hammer 3 off of the retest of that trend line break. So when he told me this morning, and I was like, oh my gosh, like, yeah, this is going to go up, because you had a hammer 3, retested the trend line break, and then now look, continuation. And then you had another hammered 3 in the hour, and then look, it went all the way up to end the day, and then obviously we got the Globex sell-off that's going right now. But hammered threes, because once you get the 2 up following that hammered 3, that's your confirmation. Yes, we know that outside bars exist. Yes, we know that you can go 3-2-2 rev to the downside. But I'm telling you, more than 50% chance that it's gonna go up, I will take my chances. And if it's on a higher time frame, and that's all it requires me to swing, I'll take my chance. All right. So these actionable signals, you want to know, if when I first started trading the strat, you guys probably remember inside bar all day, inside bar all day. Give me a 2-1-2 rev. Give me a 3-1-2 rev. Like, or 312 continuation. Those are that's what I love, and I still love those, right? Don't get me wrong, but you need to find the one that works best for you, and that's the beauty of it. Alex Strat, the reason why I call him 3-1 specialist is because he loves those 3-1s, right? I believe he took, what was that? Was it Square that you took that 3-1 weekly?
Yeah, yes, sir. It was Square, I think.
On the 2?
It wasn't the 3-1 though.
Oh, it wasn't a 3-1? I thought it was a 3-1. Really? I thought it was a 3-1, whatever. But
Might have been daily,
no,
I
it
think.
was. No, you're right. It was a 3-1 on the month.
Oh, monthly, yeah.
Yes, sir. 3-1 on the month. So, bro, it's probably about to be a year now when we had that conversation. I always talk about the time where we had a midnight session and all we were looking for was those 3-1 setups because we noticed that a 3-1-2 goes crazy. It can lead to a 3-1, 2 up, 2 up, 2 up, 2 up, 2 up. And then he literally said, hey, you know what? I'm just going to be playing 3-1 setups. Why? Because he knows that the likelihood of it going 3-1, 2 up, 2 up, 2 up, 2 up is high, right? And so for that reason alone, he can just be playing those setups. Like you can literally just be playing 2-2 reversals. You can be playing 1-2-2 reversals, 1-3-2s, or like it doesn't matter. Whichever the one that you feel most comfortable with, those are the ones that you should be playing, right? And that it's just gonna add to your confidence and add to your analysis when you see those type of setups. Then like that's why HD. The reason why I was like, oh, HD on the week and Rob likely because it was a 3-1 on the week. I know the chance that HD can do a 3-1, 2 up, 2 up, 2 up is high. So hopefully that makes sense. Actionable signals. I think there any more. And then we just talked about continuations. We already talked about that. Reversals. We talked about that. These are examples of reversals, right? You have your 3-2-2 reversal. This is a 3-2-2 rev for Apple on the month. Remember, and this is irregardless of candlestick color. Okay, the candlestick color definitely adds to the analysis, right? If you have a hammered 3, obviously if it's a green hammer, then you know the bullish side, you can have more of a bias to the bullish side than to the bearish side. But in reality, the strat is irregardless of the candlestick color. So if you see a 3-2-2 rev, like 3-2-2 possibility for a 3-2-2 rev back to the upside, even if it's red candle, even if this 2 candle is red right here, it could still lead to a 3-2-2 rev back to the upside. As long as it breaks the high of this candle, then you know that the possibility of a 3-2-2 rev is now in force, and you can take it to the top of the target. Okay. Reversal, going over that. Pivot machine gun. Pivot machine gun is when you have a series of consecutive candles to the upside or to the downside. So in this example, you have price going up, right? So you have a 2 candle, then you have an inside candle, then it goes 2 up, 2 up, 2 up, right? So originally, the people that wanted to go long on this stock, let's say that this is Apple, right? So you want to go long Apple. You place your stop loss at the bottom of, this is a daily chart. So you place your stop loss right here, okay? You want to go long. Next day, you have an inside candle, but it doesn't break your stop loss, so you're still in the play. The next play, it goes 2 up. So you're like, oh yeah, for sure. We went 2 up. All right, go. I'm going to move my stop up. So you move your stop up to this candle right here, okay? The next day, Apple goes 2 up again, and you're like, yeah, let's go. I'm going to move my stop loss because you want to protect your profits, of course, right? Like, let's say you're in shares. So, of course, the whole point is to protect your profits. So you move your stop up. Don't forget, it's not only you that's in Apple. You also got Tim in Apple. You also got Amy in Apple. You also got Cooper in Apple. You also got Sam in Apple. You got about 5,000 people in Apple, right? And they all are moving their stop ups as well. Why? Because they want to protect their profits. Apple goes up again, right? 2 up on the day. You move your stop loss again. All these people have their stop losses placed here. Then the following day, you now have one bearish engulfing candle that takes out all these stops. Okay, what leads to this movement, or what we call a pivot machine gun, is due to the acceleration of selling pressure. I want you to think of it like this way. Let's say you're the guy that was originally long Apple here, and you moved your stop loss up to this point. You now see that that stop has been taken out, right? So now you get out of the play. Amy also has her stop loss right here, and she sees that, oh snap, price is coming down quick. Oh, I don't want to lose my profits. Let me get out of the play too. Amy decides to get out of the play. Selling pressure accelerated. Then you see Duncan. He's like, wait, why is Apple going down? Oh man, I want to make sure that I protect my profits too. I don't want to get out on the trade. He gets out as well. Now imagine all these people now at once getting out of their position because they see that price is coming down and they want to be protecting their profits, because remember, they've been moving their stop losses up. Yes.
Can you make this bigger?
Oh yeah. Sorry. They've been moving their my apologies. They've been moving their stop losses up, right? So that is what leads to the acceleration of that downward pressure, because all these people that were originally long Apple and they wanted to protect their profits because they were moving their stop up, they see this red candle and they get scared or frightened, or they don't want to get taken out of the position, and that's why they start selling their position at a fast rate. And that's what leads to that PMG down. If you look at let me show you examples right here. All right. Yes.
Not to contradict you or anything, I just wanted clarification. I have read elsewhere and heard people say that retail investors like you and me, don't influence price. It's institutional buying and selling that does. So, can you just clarify this with the example that you're highlighting?
Yes, great question. That's great question. So going back to this example, when I take that the names like Duncan, Amy, Tim, I actually don't mean that. What I actually mean, I mean Berkshire Hathaway, Morgan Stanley, JPM, Bank of America, Wells Fargo, BlackRock. These are the people that are long Apple, right? And remember, they have up to billions, millions, and billions worth of shares, right? Dollars are worth of shares. So that's what actually leads to the acceleration to the downside. Because imagine if you had 500,000 shares worth of Apple right here, and you see it's coming down, you're like, oh shit, nope, I want to get out. So 500,000 shares get out of the market. Then the Berkshire Hathaway, they have an additional 500,000 shares, and they're like, oh snap, Apple coming down, nope, I'm getting out too. Boom, 500,000 shares get out of the market. And then so forth and so forth. So it's not necessarily us with our 100 shares or whatever we have. I'm talking about these institutions that went long and they're moving their stops up.
Okay.
Mm-hmm. And do you see how if you get millions and billions of dollars worth getting taken out of the stock at one time, why it can drive price lower? Yeah, and that's what it is. And so if you go back to the chart, cat, I think today, cat PMG down today. Okay, what we mean by PMG down, and what you can literally see, and sorry, I'm gonna do the noise again, but it's so what happens is you have your inside day, you go 2 up, 2 up, 2 up, 2 up, 2 up, and then right back down. And you see how in 2 days you were able to take out 1, 2, 3, 4, 5, 6 days worth of data, or 6 days worth of continuation. That's what a pivot machine gun is. A pivot machine gun, why it's a pivot machine gun? Because the rate at which it happens faster than that direction that it was going originally. If that makes sense. You can do a PMG up and a PMG down. Cat on the monthly had a PMG up. On the monthly, it had a PMG up. Why? Because if I remove these drawings, what did it do? Cat was going down, 2 down, 1, 2, 3, 4, 5, 6 months. And then in 2 months, it took out the highs. It took out 6 months worth of data. So you can have a PMG up and a PMG down.
Can I just say, Dex, that the PMG down is exactly what happens whenever I...
With what? Whenever you what?
Whenever I place a trade, once I enter into a trade, like it seems like the selling pressure becomes heavy and I just take a loss.
Maybe because you're entering a trade at the open, and also, well, not at the open, you're entering a trade too early, and also a PMGB down could be occurring at the smaller time frame. So like, for example, Let me see if I can find. No, I'm not really gonna. Oh no, this is one right. So on the 6-minute chart, right, you see that there's a slight PMG down to the downside, but then we retrace back up. But if you were to look at the hour, you don't even see that PMG down at all. Like, you don't even notice the PMG at all based off the hourly charts. So that is why when I get into a trade, so you're gonna hear me say, like, how much time do you have in the contracts? What is the reason why you get in a trade? Like CVS today, right? CVS triggered 2 up on the day and immediately failed. We triggered 2 up on the day right here. Daily call trigger. Okay, we triggered 2 up on the day and then immediately failed, right? And you were down like 40, 50%, like 50, 60%, right? It immediately failed. So it PMG down. Literally, you could look at the 3-minute time. All right, as soon as it went up, PMG right back to the downside, right? So it failed. The trigger initially failed. However, because of the fact that I was looking at CVS based off the higher time frames, that hey, it already triggered 2 up on the week. For some reason, they're buying this stock even though it's been in a downtrend to the downside, and we're coming off of a 3 on the day, right? I know this could lead a possible 322 to the upside. So unless CVS makes another outside day, goes 3-3 on the day, then I won't be getting out of the play. And then you could see on the 30-minute time frame, right, after it triggered 2 up, it consolidated for a little bit, and then end of the day you had that little push up to be pretty much near to the daily call trigger, right? So I understand that going into the trade, you have to just understand that going into the trade, it doesn't go straight up. That's the thing that a lot of people need to realize as a trader. Your trades will not go straight up. It doesn't work like that. You have to understand that you need some down. I like to, like, I have a saying that red means green, red means green, red means green. If you see that the trade is down, that doesn't mean that the trade is done, right? It could just be consolidating for the next move up. That's what, and trust me, bro, I used to be exactly like you. As soon as it saw red, I was like, oh, let me get out of the trade. But then I noticed that all these charts that I was charting, right, they would end up going crazy, like after that 9 o'clock, after the 9 o'clock lunch or whatever. And I'm like, wait, what? But why did I get out? It was because the trade wasn't done. It was just consolidating for the next move up. Trading Wars, I haven't watched his videos in a while, but he used to talk about the 2-leg rule, right? Where price moves in 2 legs. That helped me stay in trades longer, understanding that, hey, when it initially breaks 2 up on the day, there might be a second leg that may occur later on in the day. As long as it doesn't reverse on the day to go 3 down, wait for that second leg. And that's what has made me stay in trades longer, because I assume going into the trade that they're going to give me a second leg. I don't know if it's going to be in 30 minutes. I don't know if it's going to be in a couple of hours. I don't know if it's going to be at the end of the day. I don't know if it's going to be at in 2 days. HD was a perfect example where it gave us a second leg, but the second leg was today, right? The second leg HD, we took the trigger yesterday, but it was an inside day, and then today is when it did the move, right? So that's what oftentimes happens. It may not happen initially, it may happen later on, but you need to trust yourself in the charting and the analysis that you did the night prior, that it's going to be going in that direction. Does that make sense?
Yes. In that case, what's your advice around the general timing for averaging down? Since you know that it's a 2-leg race, would you suggest averaging down like to profit from the next leg?
So I don't suggest averaging down on weeklies unless you know what you're doing. I do not suggest averaging down on weeklies unless you know what you're doing. I like averaging down on my swings because I ultimately believe as long as it doesn't break my validation level to the downside, this play is still cooking, right? Like Oxy, for example. Oxy, I wanted Oxy to come down more, but Oxy, we're down. For me personally, I'm down like 30% on my position. But Oxy was a perfect example of where I can average down because of the fact that I have March contracts and we're now presenting us with the hammer day. See? So, like, when you look at this candle, this Oxy is a beautiful example of like, yo, what is the chart telling you? Like, what is this chart telling you on the daily? On the daily time frame is literally telling you, hey, we opened at 64.20, we went down, they hammered price, and they closed price literally at the high of the day. So when I ask you who's buying or who's selling, right? Imagine you as a buyer. Imagine you bought Oxy today, right? Based off this candlestick today, do you think Oxy is going to go up or down tomorrow? Based off the candlestick today?
Up.
Thank you. And there's your analysis. Because the candlestick is telling you that, hey, they bought it. And what was the reason why they stopped buying? Because market closed at 4 p.m. If it wasn't for the market closing at 4 p.m., they probably would still be buying. If Oxy could be is a futures equity, Oxy would probably be up right now. But the only reason why it's not is because the stock market closed at 4 p.m. So if Oxy breaks 2 up tomorrow, do you see why I will be confident in taking the play? Because they have told me that yesterday they were buying up the stock. This can just be continuation from yesterday's move. Because the candlestick is telling me that, hey, buyers are here right now on the daily. Tomorrow morning, if it opens 2 up, that's just a continuation from what they were doing at 4 p.m. yesterday.
Makes
and that
sense.
adds to the confluence. Does that make sense?
Yes.
Sure. Good, great question. Let me go back to the pivot machine gun because I'm pretty much done with the presentation. I apologize for taking all you guys' time. That's the pivot machine gun right there.
Can you talk about how you play the pivot machine gun?
Oh yes. So Cat was a perfect example. Cat
when you get in.
Oh yes. Let me go to the chart. That was actually a perfect example. So Cat has been at this yearly BF. Okay, so this is a broadening formation that I drew. I don't remember on what time frame, right?
But we're not seeing the chart.
Oh, sorry, my apologies. Okay. Let me go to XLE. XLE. Okay. XLE has a yearly broadening formation right here, right? You can see that we wick here and then we wick at these 3 levels right here. So you can draw your BF. So this is a BF from here to here. Okay. Then when you see that price is about to reach the broadening formation, so when you see that price is about to reach the broadening formation, you can get ready to short. Okay, if they give you an actionable signal to the downside. So XLE is an example where it led to a possible PMG to the downside. You're getting to the top of the range, right? You have the wicks here, you have a wick right there, you have a wick here, you have a wick here, getting to the top of the range, and you know that this can lead to a possible PMG back down. The reason why it could lead to a possible PMG back down is because XLE has been going a series of 2 up, 2 up, 2 up, 2 up, 2 up, 2 up. And when that happens, you know, not the likelihood, but the possibility of a PMG back down is high because all these people who are along XLE, right, all these hedge funds and things like that, they place their stops here, 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 and here. Okay, and then what needed to happen? Shooter. You see how you have a shooter right at that Browning formation? So this could be the start of the reversal. Hey y'all, now we've got a shooter on the Browning formation. Let's see if we could start to short energy here because we're at a yearly BF. Boom. See? Next candle, they gap it down. Okay? And that's your first 2 down candle after going consecutive candles of 2 up, 2 up, 2 up, 2 up. So they actually rejected at the yearly BF, and then I think we started to come down a little bit. There we go. There we go. So we're starting to PMG back down to the downside. So far with 3 candles, we've taken out 1, 2, 3, 4 candles up. And SMH end phase, yeah. Oh, end phase, perfect example right here. Wow, you see this? I even marked it. That's crazy. I marked this short.
I hate when that happens to me.
Bro, don't grunt like that.
Dude,
Low-key though.
Dude, that's crazy. All right, but this is a perfect example where you see price.
I feel it for you because end phase pays well.
No, I do remember you talking about shorting the crap out of end phase. And how you were like, this is going to be a huge short.
Oh my god. That's okay, but back to this example. End phase is one of those like Costco and Cat where it respects BFs to the T. Like you see that on the daily, we tap this BF, come down. Tap this BF, come down. Tap this BF, come down a little bit. I actually shorted this and I shorted it to here, but then it reversed back on me and I had to get out. And I was like, what the hell? But then it tapped the BF again and look, came down. So it is, end phase is one of those ones where it will go from BF to BF. And if you're at the top, just buy some time and wait for it to go short. But it literally does it to the T, right? So as soon as I see, I think the actionable signal was on the weekly. Was it actually? Yeah, it was on the 2-week chart. No, it was on the weekly chart. That 3 right there. That 3, man. So they did a hammer, then a shooter combo, and then they went 2 down. So this right here, where to go back? This could be your entry as long as price does not go above this Browning formation. So does not go 3-2 up on the day. You know the possibility of a short is coming, right? And this will be the start of your PMG back to the downside. When things are starting to break new highs of the day, you want to see if you could PMG down. Merck was another one. Merck said, we're going to go 1, 2, 3, 4, 5, 6, 7, 8 candles up, and we're gonna break it down in 3 candles. That's a PMG. So this is what happens with price. This is just how price works. And this is why personally, I don't, and Abby side, he doesn't get shaken out of his positions when he sees price coming down on the 30. When he talks about the 30 minute, like, oh, price is coming down, price is coming down, price is coming down. As long as it holds this level, we should reverse back to the upside. Because if you see price coming down, we're flagging, right? We're flagging and it could lead to an explosive move back up. HD on the 30 minute. I was watching HD on the 30 and I was like, no way. And it did this. Look at what HD did the last 30 minutes. If you guys were in the HD trade, it said at 30, what was it? At 1:30, we're gonna have a red candle. 2:30, we're gonna 2 o'clock, we're gonna have a red candle. 2:30, we're gonna have a red candle. 3:30 we're gonna have a red candle, but then at 3:30 in one candle, PMG back up to the upside. And see, that is 2 hours worth of data taken out in one candle. So you guys, I want to tell you now, when you guys are long, like, because trust me, this was hard for me in the beginning as well. When you're in a trade, when you're in a weekly trade, and then it goes up and then it starts to come down, please, promise y'all, do not be scared. Do not be scared. You need to understand that red means green. You need price to come down for it to make the new high. You need price. You need Costco. Abisai, remember, bro, when I called you when I got last week or 2 weeks ago, as soon as I got out of my flight, I called you and I said, yo, what happened to Costco today? And he was like, yeah, bro, the market was down. And I was like, damn, bro. And I was like, damn, I'm down 60% on my Costco swing. And he started laughing. And I was like, well, I got 3 weeks left on the contracts anyway. I got out this was on Thursday when I got out of my flight. It's down 60%. But then the next day, y'all, Costco, hammer day, then 2 up the next day to take out the range. You need
I think you should also show, I mean, I know this is strat related, but I think you should also show them with fibs where that drop went into.
Oh yeah.
Well, not there from that bottom that you're about to select to the top of that range that was in the consolidation period. Because this range is the one we use for the targets.
Right there.
Costco made me low-key cry.
Really?
But I am taking every penny that she took from me. I'm almost there.
Hey,
reverse your fibs real quick, Adex.
Reverse it? Okay.
Yeah, just reverse them. No, go down to that shooter. The shooter that's right after that 3 on that consolidation period.
Right here?
No, keep it on that low of that 3.
Okay.
And then on the higher range, go to the shooter that's like 2 candles after the 3. To the right.
The right. Here?
Not to the right.
Oh.
To the right, that's your left. Yeah, keep going. You see where you have that 3 red hammer?
Right here?
That green shooter. No, the top of that green shooter. Yeah, there you go.
This one. There we go. There we go.
There you go.
Oh yeah. So this one, okay, so we were creating our first, this was our first high, right? And now we were getting our first retracement. And look at where the first retracement occurred, at that 50%. Actually, market. This is why the 50% is goated, y'all.
Dude, 50% and the 0.618.
618 is goated. And you remember how I told you the close is important? I'm telling you, look what they did. They said, oh, 50% right there? Nope, we're gonna close right above. And the next day, 50%.
And also, while you are on this topic, what's also really relevant to this daily chart for Costco is you guys see how on the left it's just on a continuous downtrend, right? You make those highs and then you make the lower highs and the lower lows and the lower lows, but then price just has a big old green candle that comes in, right?
Yep.
In strat, that's known as your kicker pattern. And these kicker patterns can be really, really powerful because when they come in, especially on a daily time frame or a weekly time frame, and they are counter trend, that's telling you or showcasing you that the narrative is kind of changing and the investor sentiment has changed. So when you see things like this, and when you see those kicker patterns, and when you see those gaps start to get defended by buyers, then you have this really powerful move that's probably going to follow. And I challenge most of you guys, or whoever wants to go look at previous daily charts and look at charts in particular that had earnings and that gapped up after earnings, and then look at what price did afterwards. Because Costco is kind of the same thing, although they didn't have earnings, but they had some really good news that day. I believe it was something about their December sales. I don't remember what it was. But for the most part, is that news-driven day caused investor sentiment to change. And now look at what Costco has done since. that gap has been protected. Even on the retracement, it was bought right back up. And Costco is just going on and up to fill in all those liquidity areas that it has to the upside and stuff like that. But do not sleep on kicker patterns. Post earning gaps, kicker patterns that are news driven, whatever. It's all some form of investor sentiment change, and they can be really, really powerful, especially for swings.
Also,
And it works both ways to the downside. Sorry.
I really think ADEX talk to Costco, and that's why it's been bullish.
Yeah, that's true.
Dude. Also, I want to mark the reason why I'm bullet, man. I'm telling you, 50% really works, y'all. If you marked 50% of SPY the previous week, look at where we bounced today on the daily. Literally.
You know what, too? To me, in my opinion, man, those damn monthly broadening formations to me have like a way higher significance than the other broadening formations.
Yeah, they do. No, you're 100% right. And the reason why is because the higher whatever broad information, the higher the time frame, the bigger the significance, right? So the ones on the monthly, they're either going to be stronger, they're stronger than those daily broadening formations. So you'll see a hard either a bigger rejection or a bigger follow through if it actually breaks above.
Bro,
So that's
tell them about those hammer broadening lows.
Bro,
how many 500 percenters have you hit from hammer broadening lows on the month?
You want to see
how many, dude?
You want to see why I knew Tesla was going? Look at Tesla.
And the month closes tomorrow, guys. So we better find all these amazing month setups.
Like Tesla on the 3-week, literally, if you draw a broadening formation.
Hey, you know what? I don't want to cut you off, but honestly, man, and I'm just saying that, to all of us in here or whatever. But I think some people need to learn how to chart versus like just taking plays or, things of that nature. And I say that because, some of the messages I've been getting, I don't want to put nobody's business out, but they don't know how to chart, or even, find plays, although, we go over this, or y'all have, whatever, but they don't know a lot of things, well, information, whatever.
Mm-hmm.
So what are you saying, Sal? You want to do a class?
You're gonna do the class. I don't know, man. I don't know, man.
Okay, so what would you recommend for a charting class? Just like basics, because there's a bunch of things you can do with charting. Charting is like art, you can paint it in many different
absolutely,
ways.
but it's like
astrology for men.
Yep.
Yeah.
I think the basic, just learn the basics of charting. Some people don't, know. I mean, hell, to be honest with you, man, I've taken some damn trades where I haven't even fucking charted, but I know, where a particular price target is at. I have different watch lists and shit. And if I can see some shit running or a sector running, I'm going to a tick in a setup that I like. And if it's, triggering on a 1 day or 2 day or whatever, I'm just gonna take it.
Yeah. No, I actually agree, man, especially for beginners. I think learning a way that best fits them.
So I'm actually glad, Sal, you said that, because that is actually what's going to be my focus for this year. Is we're doing a strat curriculum. So, and Alex, bro, I know you're heavy onto this as well. What I want to try to do for this year is, because that's something that I got a lot of comments on, that hey, we hear you talking about the strat, we hear you saying this, but I still don't know what I'm doing, or I still don't know what I'm supposed to be drawing and things like that. I want to try to get more.
Man, go look at my last tweet. I don't even know who that is, but I know he's in here or whatever. Go look at my last tweet. Like, it is a prime example of what we're talking about now.
I'm gonna look at it. Once.
Wait, so is the technical analysis or the charting sessions going to be strictly strat focused? Because I can also throw in how I chart.
So it's not going to be.
But I don't want to confuse anybody, especially if it's going to be strat related.
So I'm not going to. It's not going to be strat related, because I think this is. I think I'm gonna be honest. I think the reason why I've been able to like chart okay is because of the fact that I've I've learned the other concepts. I learned chart patterns. I know what a head and shoulders look like. I know what a double top looks like. I know what a bottom of a broadening formation looks like, right? And that has able to give me like a holistic, like a, I don't know, um like a general view or broad overview of how to chart, right? We can see those supply and demand zones easily, but why? Because we know what supply and demand zone is. I studied Elliott wave analysis, so I understand that price moves in a trend, moves in trends, right? So I think this is what I want to do when it comes to the curriculum that I want to get for us this year. It's going to be like, all right, you guys, let's actually start from beginning to end. Let's actually how to set up your trading view. What's the difference between a bullish candlestick and a bearish candlestick? Charting patterns. This is the indicator, like even EMAs and things like that. I think ultimately that could probably help. What do you think?
Okay. No, I agree. Just give them a splash of everything.
Yeah. Because they need to be able to take a blank chart. You need to be able to look at a chart like this and be able to tell me if price is going up or down based on the time frame. You need to be able to look at this part and tell me that we are possibly in a major bull flag and we could possibly break out of this. Like someone should be able to tell me that Tesla is flagging right now and that a possible movement is like this. Right, because this is a bull flag on a higher time frame. All right, but back to the PowerPoint because I know I've been going. Hold on one second. Going. If a machine gun, we talked about that. These are examples that I'm not gonna go over. Yeah. Yeah, that was it. All right. I appreciate you guys. I'm gonna have part 2 at a later date, probably next month. We'll be going over part 2, and that is how we trade the strat with multi-time frame analysis and things like that. But thank you all for being here. Is there any more questions that I can ask? I will have this recording available. It's pretty long, so make sure you guys have your notes when you want to retake this. When you rewatch it. Anything else? Anything else?
Thank you. It's after midnight. It's bedtime for me.
Thank you, Novi, for being here. I really appreciate it. Sorry that I was an hour late. I'm gonna be honest. I took a nap and the nap was longer than expected. So I apologize for being an hour late to class. But thank you. I will have this recording available. Yeah. Any other questions?
No, it was worth it. Thank you so much.
You're welcome. You are certainly welcome.
Thank you very much. Thank you.
You're welcome. I will have You're welcome. I will have this recording available in the lessons tab once it's done converting its file. And then yeah, if you have any other follow-up questions, please ask me in the chat. Ask me DMs. We're here. I'm gonna have part 2 once I create the calendar for next month. I'll try to do part 2 next month for you guys as well. All right. You all have yeah.
I was just gonna say, sweet, thanks, man.
Yeah, of course. You guys all have a wonderful night, and I will catch you all later.
Later, man.
Peace out, everyone. Thanks for coming by.